When you think of Wall Street, you probably picture the movies, right? The shouting, the frantic energy, the gut feelings. But that's the old world. Today, the real power, the real action, it lies in a totally different universe. One of pure data, cold hard logic, and decisions made in microseconds by machines. This is the world of quantitative trading, and we are going to dive deep.
But let's just start with a question. Really think about it. Could you trade without any fear, without any greed, without that little voice in your head, your intuition? Could you make every single decision based on nothing but statistical probability? That's a pretty tall order for any of us, and it perfectly frames the problem that quantitative trading was built to solve.
So what exactly is this quant trading that we hear so much about? Well, at its core, it's all about using math and statistics to just plow through mountains of market data. Instead of a human getting a feeling about a stock, quants build these complex computational models to spot and act on trading opportunities, often completely automatically. And this is where it gets really interesting, because you're looking at two completely different philosophies. You could say traditional trading is almost an art form, right? It's driven by human experience, research, and judgment. Quant trading, on the other hand, is a pure science. It's all data-driven, it happens at speeds we can't even comprehend, and by its very design, it's totally cut off from any emotional bias. So here's our game plan. We're going to break this down into 5 parts. First, we'll nail down what it is. Then, we'll look at the system, the how. After that, we'll check out some actual strategies. Then, we'll weigh the pros and cons of humans versus machines. And finally, we'll see where this is all heading.
All right, let's jump right into our first section. What is quant trading? We're going to slice right through the buzzwords and get to what's really going on here.
Okay, first things first, let's clear something up that trips a lot of people up. You might be thinking, isn't this just algorithmic trading? And the answer is, not exactly. The best way to think about it is this. Quantitative trading is the brain. It's the super deep mathematical work that actually finds a potential trading opportunity. Algorithmic trading, that's the muscle. It's the automated system that follows the brain's instructions to execute the trade.
And this is honestly the perfect analogy. Think of it like weather forecasting. Meteorologists don't just stick a finger in the air to see which way the wind is blowing. No way. They use these massive supercomputers, feed them tons of historical and real-time data, and build models to predict what the weather's going to do. Quants are doing the exact same thing, just for financial markets. They're looking for probabilities in all that chaos.
So how does this actually work? How do you go from an idea to a live trading system? Well, let's get into our next section. A real quant strategy isn't just one magic idea. It's a really rigorous system that's built on 4 essential pillars.
So it all starts with strategy identification. That's the creative part, the hunt for some kind of pattern or inefficiency in the market. Then comes the second step, and this is absolutely critical, backtesting. You take your model and you unleash it on years, sometimes decades of historical data to see if it actually would have worked. If it survives that trial by fire, then you build the execution system, the actual code that talks to the market. And finally, you wrap that whole thing in a tight layer of risk management, because without that, even the best strategy in the world can blow up. Okay, now for the part everybody wants to know about, the secret sauce. What are these models actually looking for? What are they programmed to do? Let's pull back the curtain on some of the core strategies that really power the entire quant world. And wow, the quant toolkit it's huge. You've got mean reversion, which is a bet that prices that stretch too far one way will eventually snap back to their average. Then you have trend following, which is basically just riding the wave of market momentum. Statistical arbitrage is all about finding tiny price differences between really similar assets. And it gets even wilder, with models that scan social media for sentiment, or even exploit the internal rules of how ETFs are managed. So let's zoom in on a real classic here, statistical arbitrage. The logic behind it is just beautiful. The idea is that two companies in the same exact business, like Coca-Cola and Pepsi, their stock prices should pretty much move in sync over time. This strategy is designed to make money in those brief moments when they fall out of step. And here's the perfect example of how it works. A model is watching the price relationship between Coke and Pepsi 24/7. Suddenly, for a split second, Coke's stock dips while Pepsi's ticks up, breaking their usual dance. The algorithm instantly, and I mean instantly, buys Coke and sells Pepsi, making a bet that they're about to snap back into alignment. It's this tiny, fleeting opportunity that a human trader would miss 100 times out of 100.
But, and this is a big but, this approach is not a silver bullet. Handing over the keys to an algorithm creates a very specific set of strengths and some really serious potential weaknesses. So let's break down the pros and cons.
So the upsides are powerful, and they're pretty obvious. You get total discipline, no fear, no greed. You get blinding speed and the ability to scan the entire market at once. But the downsides are just as significant. Your success is completely tied to your model. If the market suddenly changes in a way your model wasn't programmed for, it can fail and fail spectacularly. And then there's the ever-present danger of overfitting. Building a model that looks absolutely perfect on past data, but then completely falls apart the second you use it with real money.
And that all comes down to this single crucial warning. A model is just a snapshot of the past. It's not a crystal ball. Markets are always evolving, relationships between assets break down, and what worked yesterday is never, ever guaranteed to work tomorrow. That is the fundamental risk every single quant has to live with.
So where does all this leave us today? For our last section, let's take a look at the incredible evolution of quant trading and, maybe more importantly, where this whole thing is headed next.
This whole field started out as academic theory back in the 50s. Then, computers in the 70s and 80s made it actually possible. The big hedge funds proved how powerful it was in the 90s, and then the 2000s, well, that's when we saw the explosion of high-frequency trading. But the most disruptive, game-changing shift of all, that's happening right now.
And this, right here, is the biggest takeaway. For decades, this was a game that only giant institutions with billion-dollar budgets could play. But today, with powerful computers in our homes, with open-source software, with direct market access through APIs, those barriers are just crumbling. An individual with the right skills in coding and math can now build and run incredibly sophisticated strategies from their own home office.
Which brings us to our final, really critical question. As these algorithms keep getting faster and smarter and cheaper for everyone to use, what happens to the rest of us? In a market that's becoming more and more of a conversation just between machines, what is the future role for the human investor? It's definitely something to think about.